Welcome to this episode number 21 of Your Next Trade, called today Position Matters. So let's start first with one of the questioning that I had on the Discord channel, which was about how to look at the some positioning of the what we call the CTAs. So CTAs stands for Commodity Trading Advisors. So here, as we can see in this chart that has been taken from Twitter. So on Twitter, you can find a lot of those data for free, and the origin was from Citigroup, looking at the different asset classes and how what we call the CTAs, or the funds that will be looking for big trends. So those CTAs funds have been doing very, very well in 2022. 2023 has been a bit more of a stretch. Why 22 was so great? Because we got currencies, the big move in Japanese yen, in the euro dollar, bonds that sold off the whole year, same with stocks. So really they had a 15-20% year. And starting from January, the market has been going up and has been struggling since mid-Feb. So what is the positioning? How are those CTAs positioned? So in light blue, we get the current long, so which stands, we have here the silver, we get the soybean, we get, interestingly, Euro stocks with Europe, where CTAs have been very aggressive, very long this trend, and to have a break even where those CTAs will go from long to neutral and then maybe to short, we need the market to go into the 40, 50, 40, 80 for the Euro stocks, which is 100 points from the close of as of yesterday. If we look at the S&P positioning, where is the flip? The reference is 4,000. So roughly 4,000 has been one of the big magnets for the S&P. We have been covering this magnet for the last 3 months, where the market very often, due to options positioning, was going into 4,000. If we start to go well below this 4,000, the CTAs, the trend followers will be starting aggressively to be selling the equity market, the stock market in the US, through selling the S&P, through selling the Nasdaq and the Russell. So positioning really, really matters. You remember 3 weeks ago, everyone was telling you, don't miss the rally. We are at 41.80 on the S&P. We're going to go much, much higher. And the positioning, people were saying that some investors were underweight the market to neutral, but actually we could not really be checking, because the commitment of traders, one of those indicators, is not working these days. But literally what you could feel is there was a tail of the market telling you, oh, people are underinvested, and that was not the reality. And we flipped, and now the positioning is going to be really interesting in the next few weeks, because we are at important level on the US equity market. So what about the year-to-date asset performances? Now, S&P is up only 3.4%. So we gave up a lot of performance over the last couple of weeks. We are down 5% from the highs. We are talking single digit for same for the Nasdaq, which is up 9%. The stocks 50, which is up 10%, which is for Europe, outperforming the other markets. As you can see, this is the outlier. And as we've seen just before, that is partly explained by the trend followers, the CTAs, which have been very aggressive in buying this market. Shanghai up small. Then looking at FX, we had first a weakening of the US dollar. Now the dollar has been strengthening. So DXY, which is 60% roughly euro dollar, is up on the year. Why? Because as we're going to see later, and as we discussed before, yields in the US have been up. We are talking 2, 5, 10 years. So all the rates have been going up in the US due to the fact that inflation is still very present in the US, and the Fed has to be more hawkish than the market was pricing even 2 weeks ago. Crypto up 40%. So But that is to put into perspective after a 70-80% down year. Then for the commodities, looking at the gold and the WTI, so gold down 5% and gold flattish for the year, WTI down 5%, as we're gonna see the trading range for WTI, which is the same 22.83, and more compression. Natural gas down big time because, as we said before, warm weather in the US. What about the week to date? So week to date, very interesting. We had a risk off. So we had the OPEX a week from before. So that was 8 days ago, where we had the option expiry on the futures and the options in the US. The week 10 days ago was pretty weakish, and then we had a follow-up. So the positioning very often, what happens is from one big monthly OPEX to another one. This is the time where it's gonna hard to change the drivers of the market. So week to date asset performances: S&P down 2.7%, Nasdaq 3.3%, same with the Euro stocks 2%. MSCI here minus 2.6%. So literally 2 to 3% off in the market for the equity. Then, similar to the risk off, what we have is not a rush, but a move for the US dollar. So we underlined that was a couple of weeks ago on the ECB day, on the Thursday, when the euro dollar reached 110, that the price action on the day we started to reverse. And since then, we have been going from 110 on the euro dollar to 105.5. Same with the dollar yen, with the yen weakening, and despite the new Bank of Japan governor talks on Friday morning, the change is not good enough for the Japanese yen to reverse. But I think what has been interesting as well, if you look at the CNH, which is for the CNH, CNY, if you look for the renminbi in China, what is interesting is the same. The Chinese renminbi has been really weakening, especially this week, and I find it pretty interesting that obviously this is mostly explained by the dollar strength. But you remember in January or not, that there were a lot of talks in terms of positioning. You need to go long the market because China is reopening. China is super strong. And actually, if you look at the currency, that is not the case. So I think now, looking at, for me at least, for the USD CNH, it's 80% dollar strength, but you get a 20% question mark of, how strong is the China reopening? And that's going to have a lot of implications for the market going forward, as looking at luxury stock, looking at car stocks, looking at exports versus imports. So really start to be looking at USD CNH. Gold, WTI, flattish, copper down. And that's another, as we're going to say for technical analysis, look at technical analysis, that is another tell that the Chinese reopening is not as strong as market participants were expecting a month ago. What about the year-to-date industry's performance? You can see the divergence, if we have the S&P that is here, between the winners and the losers. So far, you still get much more winners than losers, okay, because the market has been on a risk on until the 20th of Feb. Silver, gold miners, utilities, anything that was more defensive has been pretty weak on the year, and the strongest part have been semiconductors, very strong. We got the NVIDIA numbers this week that were just okay, but they mentioned probably 50 times more artificial intelligence, so that helped the stock. In the long run, still many question mark on the sector and the implication for the China and US deal. What about the week-to-date industry performance? That is one of the clearest picture of a risk-off. So the risk-off, this is literally some of the charts that you will have had last year, where the only one standings will have been energy and the US dollar. Energy was down 6% the week before, so kind of, outperformed for this week, but over 2 weeks it has been a bit more of a struggle. US dollar strong and everything in the red. Okay, so total risk off, you're selling everything and you go for the US dollar. What about the sector's performance? Sector performance on the year to date, the picture is still the same. Everything that was a bit defensive, from healthcare, utilities, consumer staples, not energy, because that was the reversion to the mean from 2022, but underperforming, and the rest, telco, consumer discretionary, and IT outperforming. For the week to date, the picture is really, let's say 90% of the stocks that were down except energy. So we had a risk off. Going into rates, if we start with the 10 years and the 10 versus the 2, so starting with the 10 years, looking at the week to date, the change. So the 0.13 means that last week on Friday, the US 10 years was at 3.82%, and it moved from 3.82% to 3.95. So if you look at that chart, we went to 430 to the 340, and now we are back to 3.95. Why? Because inflation is still there. We get the second round of inflation, which is caused by services and not by manufacturing. What about the yield curve, looking only at the 10 versus the 2? I know that some people will be looking at more, and I am as well, but it's just for the sake of the presentation. We are still close to minus 90 bips. 2 years has been aggressively on the way up this week, so the short part of the yield curve have been very aggressive, and that explains the minus 90 bips. What about the euro dollar? Euro dollar, looking at what are the Fed expectations and what is the terminal rate. So the terminal rate still in September 2023, where we are still expecting a hike. As you can compare the 17th of Feb, which was which was last week, to what we have as of yesterday, we can see the red goes down to the blue. In other words, if we go down, we expect the Fed, or market participants are expected the Fed to be more hawkish and to be more aggressive in raising rates. And that means now these days we have roughly, if you take 94.49, so 100 minus 94.49 or minus 94.34 here, that means the Fed is expected to go around 5.5% roughly for the terminal rate. So still some way to go. And that explains some of the risk off that we had in equities that explain as well, the strength of the US dollar. What about the VIX? VIX 22% now versus a 17% year to date and 20% as of last week. So VIX implied volatility has been on the way up. What has been interesting as well is to see that some days the market, I think it was Thursday, if you look at the straddle, the market was downplaying and underpricing the move, the option, through the option. So there's a kind of mispricing of some straddles. And I think if you are looking for some pain in the option is where you see market participants selling over and over implied volatility at one stage. Actually, the realized volatility is much higher, and that could bring some pain. Quickly, I didn't have the time, and I think I'm going to be taking a bit of time to explain a bit more the trade through the community. I looked yesterday, so on Friday, for those of you who are following the European market, Linde, which is one of the biggest market cap, has been going out of two indexes, the Euro Stoxx 50, which is one of the biggest index in Europe, and the DAX. Why? Because the stock will be delisted at the end of this month, and that created some pressure on the stock before for the last 2 or 3 months since they announced. But on the day, so this is the green here, this is this line here. On the day, actually it overshoot on the auction. In other words, if you look at the print of the Euro Stoxx 50 on Friday, the Euro Stoxx 50 printed, so the last price of the Euro Stoxx 50 was roughly down 50 bips, 0.5% from the last. And in the meantime, Linde was up 3% and all the other stocks went down. So we are talking here, I put ASML, I put LVMH, Total, Sanofi, SAP. So some of the big weightings of the of the Stoxx 50, where Linde was up and all the others were down. So if you are looking at a risk-free trade, what you will be doing when they are dual listing, which is the case for Sanofi, which is the case for SAP, for Total, for ASML, you will be either buying the stock in Europe on the weakness and immediately selling in the US, or you'll be buying in the US expecting the stock to go up. So those are the things that I explain in the 4x4 video series through the ADR and some risk-free trade. So that was the trade as of yesterday. Important to be looking at index rebalancing. Clearly, this is something that you can do every 3 months, which happens every 3 months. And as a prop trader, this is something that you will be doing. So what about the technical analysis? So starting with the looking with the S&P through the futures. So as I mentioned last week, we broke this trend. Now we are back to this important trend that everyone spotted. That was a month for now. As I said, my view was and is still the same, that it was a bull trap, and now that there is a good chance that we might go lower. So we're going to be testing at least this trend. What is very much true is we are trending below the 50 days moving average. We are trying of playing around the 200. If we start to go lower, if you think that in terms of positioning of options, there is a big JP Morgan positioning at 36.50 at the end of March, or the expiry of March, that gives you some of the magnet. What about the Nasdaq? Nasdaq is the same. We broke the level. Now we might test the support, which is much lower, the first support. Russell is the same. We broke it. We are going lower. Emerging market, China, not very weak, but quite weak, and not really changing. The trend has been lower since the end of January. Interestingly, the stock 600 Europe has been making a low. So there is a bit, as I said, there is a misprint on Friday. So we'll have to see in the next 2 to 3 sessions, if it was only a one-off weak session, keeping in mind that, as we've said before, a lot of position, the funds that are going for trends are very long Europe, are very long MSCI versus the US. If Europe or MSCI starts to be weak and we are getting closer to the break-even point, then this positioning could change. Same with the DAX. You see that it's only one candle for the time being, but if you do weekly candle, then you see that the weekly candle is not that great, and you had rejection, and now we are going lower. What about CL1? Compression. As I said, before, over and over 72, 83 is the trading range. Everyone is looking at this one, and as always, I think the first move is going to be the fake one. But more interestingly, this is HD1, which is for copper. So copper back to the level that used to be a resistance, no support. If we break lower, and I think we're going to break lower, that tells you as well that the reopening of China is not that strong. Euro dollar 110, the rejection, we are coming lower. Dollar yen, same, we go higher. And now 2 stocks that I want to mention. I'm looking first at Costco, because Costco, why I'm looking at them? Because they have their earnings this week. I think it's on Thursday. So the trend has been very strong since 2019 and has been consolidating over the last year or so. So we are in a triangle. That is one of the charts that I'll be looking. So you get a clear support at 450, and then you get this down line. So look at those stocks for the next leaders, for the next move. And as well, looking at Tesla. Why Tesla? Not only because it's a lot of noise, but more interestingly, because on the 1st of March, as I said before, they got their analyst meeting. And I think it's going to giving a lot of indication about risk on, risk off, how the zero debt to expiry are positioning themselves, how brilliantly or not Elon Musk can carry on putting new investors into that story. So Tesla, and finally Meta, Amazon, Apple, Microsoft versus the rest of the market. I'm going to go back into a daily chart just to give you the better understanding that we are consolidating. So in terms of positioning, we are back to neutral on the S&P, on the Nasdaq for the CTAs and for some others. So we we degrossed 200 points on the S&P. Interestingly, you probably saw that many stocks that were pumped up in January have been now fading. Some are doing okay, like Nvidia, but more or less the picture in terms of technicals, many technicals have been broken. Now we're going to be retesting some of the support, some of the trend that were broken a month ago. So what about going back into this Excel spreadsheet, looking at this week, what has been happening? First thing first is looking at the S&P trend. It has been lower. So what is happening is we are now in negative gamma, meaning that the more we go down, the more we have to sell, and it's like a fulfilling promises. So it's going lower, and the CTAs might start to kick in. So if you think about CTAs, I think I read somewhere that we are talking about 200 billion purchasing or selling power, so that's pretty significant. But every single day, or the trend has been lower. What is interesting is on that day, obviously, due to the PCE, due to inflation, which was way above expectations, or at least higher than expectations, and trading month on month higher, market is still realizing now that inflation is still very much alive. So if we look at the core PCE versus the Fed funds target, so core PCE in gray versus the Fed fund target, you can argue that Fed funds target will have to go into the 5.56% to this level. So no surprise that the FOMC will have to go here. If you look at the core PC here, year on year since 2019, it is trending a bit lower, but it's not like it is going lower quickly. So in other words, we have been consolidating at still very high level of inflation, 4% plus, with months on months going higher. And now the market, from 6 weeks ago, or at least start of February, we were expecting the Fed to pivot, and that the Fed was winning the war against inflation and everything was fine. Now, PCE and other indicators of inflation are telling us that inflation is still very much alive. What is happening is inflation coming from manufacturing. So that will be ISM manufacturing prices that will come on the 1st of March have been coming down. The issue is mostly the inflation coming for services. So I'm pretty sure that if you're an employee, you have been asking to your boss a wage increase, and we have been seeing wage increases across countries from 5 to 15%, and that is obviously feeding inflation, and that will be feeding inflation for the next 12 to 18 months, meaning it's going to be hard for this inflation to come down quickly into the 2%. So in terms of what are the next numbers to look for inflation? As I said, ISM manufacturing and services. We get the CPI on the 14th of March, the PPI on the 15th of March. Then we get this big event, which is the FOMC meeting on the 22nd of March. So in 3 weeks from now. And then we got again the PCE. So some data from inflation. Then FOMC meeting. What are the expectations for the FOMC meeting? If we go into the next slide, so this is the FOMC meeting probabilities. So March, we're gonna have a 50 bips. Then 25 bips. Then in May, we're gonna have another 25 bips. Then in June, we're gonna have another 25 bips. So what is the market pricing right now? Is plus 0.25% in March, May, and June. So that's another 75 bips between now and the end of June. So don't be surprised. This is what the market is pricing. That is very, very different from what we had a month ago or 2 months ago, where 2 months ago, the market was expecting something around June for the terminal rate, but only, let's say, 25 bips to 37.5 bips. So we had an increase of roughly 40 bips to 50 bips, 0.4% to 0.5%. So that is what the credit market started to price. And the equity to the S&P, to the NASDAQ were very slow to react. So I've been trading equities for 20 years more, and it's the idea or the joke is always the same. that as an equity market, you are a bit of an idiot and you're just following the smart people, which is the credit market. And the credit market has been telling us that the Fed is going to be more hawkish. Took a bit of time for this market, equity market, to follow, but now this is the sum of the reality that it is facing. So what do we have in terms of catalysts? We're always going to have the Kansas City, the durable good orders, the Chicago PMI, but more important, first day of the month, as always, ISM manufacturing. And on the 3rd of March, we're going to have ISM services. So there has been a divergence between manufacturing and services. For those of you who have been doing the 4x4, you do know that the ISM manufacturing is a very good indicator of the economy. And when manufacturing goes into recession, very often 6, 12, 18 months down the line, services will follow. Why? Because services are all along the value chain of manufacturing, meaning that when manufacturing is slowing, then services will be slowing. If you look at the numbers that we had so far, we had a good recovery in services in January. We know as well that economy was doing fine on warm weather. Now there is a question mark going forward. So look at those two numbers. Look as well at what is the ISM prices for both the manufacturing and the services, and you'll see a divergence between the two, because as we said, ISM services have been very strong, services have been pretty strong, and there is still inflation. So what about earnings? We are almost at the end of the earnings season, but there are still some names that will be coming. As I said, Costco on Thursday, for instance, we saw that represent 4% of the market value. That will be 27 issues for the S&P. Always check the Fed speakers, because obviously they'll be talking about inflation, especially after the PCE inflation data that we had on Friday. We got, as I said, the Tesla analyst meeting. I do a bit of noise here and a bit of what is the market, how the market is going to react. We know that many options traders, many retail traders are trading Tesla on the 0D to DTE or through options only, and that tells you a lot about risk on, risk off. Finally, S&P 500 seasonality. Why? Because we are getting closer to the end of the month, where we had some sell-off in bonds and stocks. And I want always, as an investor, to be looking at what's going to happen later. If you look at the next 3 months, normally seasonally adjusted, they are pretty good. What happened in the past doesn't mean that it's going to happen again. But normally, starting from March, you get a better seasonality. I think what is important here is from one option expiry to another option expiry. When we start to sell off, it's very hard for the market to revert. So I won't be surprised to see the market going lower, both options, both on technical analysis, and finally, more importantly, as we've discussed over the last your next trade, is the earnings season in the US has not been great. This is an understatement, and in the long run, S&P will follow and is following earnings growth. So this is it for me today. For those of you who have just joined the Discord community, don't be shy, ask questions, bring some ideas. This is something that we would like to be growing. If you got questions on the 4x4 video series and or the mentoring, so mentoring, the Q2 is starting pretty soon. So if you want to join and doing a bit of mentoring, this is the time to do it for this first half of 2023. Other than that, any questions, you can either reach me or DM me on Twitter, trading community, or send me an email. As always, I hope it helps, and I'll see you next week. Bye-bye.